The Grand Canyon state is experiencing a housing market catastrophe that's catching millions of residents off guard in 2026. Across Arizona, real estate markets that were once unstoppable are now witnessing price corrections so severe they're leaving entire communities reeling. In some cities, median home prices have crashed by as much as 31% in just 18 months, wiping out years of equity and trapping thousands of homeowners in properties worth far less than what they owe. Arizona, long celebrated as America's retirement paradise and one of the fastest-growing states in the nation, now finds itself in the grip of a full-blown housing crisis. The same forces that fueled explosive growth over the past decade, massive population influx, relentless new construction, institutional investor speculation, and remote work migration, have reversed with shocking velocity. What was once a red-hot seller's market has transformed into a buyer's wasteland, with homes sitting vacant for months and desperate sellers slashing prices to levels not seen since 2018. The statistics are alarming. Across the 8 cities we'll examine today, average days on market have skyrocketed from 28 days in early 2024 to over 145 days in 2026. Inventory levels have exploded by 380% in some metropolitan areas, creating a catastrophic oversupply that continues driving prices downward. Meanwhile, mortgage rates stubbornly hovering between 7% and 8% have eliminated millions of potential buyers from the market entirely, deepening the crisis. Today, we're investigating 8 Arizona cities where the housing market isn't just cooling, it's in complete freefall. From Phoenix's overbuilt suburbs to Tucson's investor-heavy neighborhoods, from Scottsdale's luxury market collapse to Mesa's water crisis concerns, we'll examine exactly what's driving these devastating price drops and what the future holds for Arizona homeowners. To understand why Arizona is experiencing such catastrophic housing market declines in 2026, we must first examine the broader national forces that are reshaping American real estate. The housing correction we're witnessing isn't an isolated Arizona phenomenon. It's the result of converging economic pressures that have been building since the pandemic boom ended. The Federal Reserve's aggressive interest rate campaign has been the primary driver. Mortgage rates, which hit historic lows of 2.65% in early 2021, have stabilized in the 7% to 8% range throughout 2025 and into 2026. This dramatic increase has effectively doubled monthly mortgage payments for homebuyers, removing millions of qualified purchasers from the market and decimating demand nationwide. The affordability crisis has reached unprecedented levels. The typical American household now needs to earn approximately $118,000 annually to comfortably afford a median-priced home in 2026, up from just $63,000 in 2020. This 87% increase in income requirements has fundamentally restructured who can participate in the housing market, locking out an entire generation of potential buyers. However, Arizona is experiencing these national trends with devastating intensity. The state was ground zero for speculative investment during the pandemic frenzy. Institutional investors and individual speculators poured tens of billions into Arizona real estate, betting on continued appreciation. In markets like Phoenix, Scottsdale, and Gilbert, investors accounted for nearly 33% of all home purchases in 2021 and 2022, among the highest rates in the nation. As property values declined and returns evaporated, these investors have rushed to exit, flooding the market with inventory and accelerating the downward spiral. Arizona experienced explosive population growth from 2020 to 2023, with over 850,000 new residents relocating to the state, primarily from California, Washington, and other high-cost states. This migration tsunami prompted developers to launch unprecedented construction across the Phoenix metropolitan area and beyond. Building permits in Greater Phoenix alone exceeded 65,000 annually in 2022 and 2023. However, as migration patterns normalized in late 2024 and early 2025, Arizona found itself dramatically overbuilt, with new construction outpacing organic demand by massive margins. The state faces unique vulnerabilities that exacerbate its housing challenges. Water scarcity has become a critical concern, with the Colorado River experiencing unprecedented drought conditions. In 2023 and 2024, several Arizona communities imposed construction moratoriums due to inadequate water supplies. This uncertainty has spooked potential buyers and investors, particularly in outlying areas dependent on groundwater. Arizona's extreme summer heat, with Phoenix recording over 110 consecutive days above 100 degrees Celsius in 2023, combined with rising electricity costs, has made living in the state increasingly challenging. Air conditioning bills that routinely exceed $400 monthly during summer have become a significant financial burden for middle-class families. The state's economic base, while diversified, remains vulnerable to tech sector volatility. Major employers in the semiconductor, aerospace, and technology industries have implemented substantial layoffs since late 2023, totaling over 22,000 positions. The retirement migration that historically supported Arizona's housing market has slowed significantly as stock market volatility and economic uncertainty have reduced retirement account balances. Finally, property insurance costs have skyrocketed across Arizona. Homeowners insurance premiums have increased by 45% to 75% since 2022 in many areas due to severe weather events, wildfires, and insurance company exits from the market. Combined with elevated mortgage payments and utility costs, these insurance obligations have made home ownership increasingly unaffordable for Arizona's middle class. City number 1. Queen Creek, Arizona. Queen Creek's housing market has experienced one of the most severe collapses in the entire state. The median home price in Queen Creek peaked at $565,000 in April 2022, but has plummeted to $385,000 as of January 2026, a catastrophic 32% drop. Days on market have exploded from an average of 19 days in 2021 to 158 days currently, while active inventory has increased by 425% compared to 2022 levels. The root causes center on explosive overbuilding and speculation. Between 2020 and 2024, Queen Creek's housing stock nearly tripled as massive master-planned communities transformed former agricultural land into sprawling subdivisions. This construction frenzy was driven primarily by speculation, rather than organic demand. When the market turned, Queen Creek was left with thousands of excess homes and virtually no qualified buyers. The city's extreme distance from central Phoenix, approximately 40 miles, has become a critical liability. Rising gas prices and return-to-office mandates have made the daily commute increasingly untenable for workers. Water supply concerns have also emerged, with the city heavily dependent on groundwater in an era of drought. An estimated 27% of Queen Creek homeowners who purchased during the 2021-2022 peak now have negative equity. The rental market has completely collapsed, with vacancy rates climbing to 14.2% and rental prices declining by 19%, year over year. Foreclosure filings have increased by 89% compared to 2023. Entire subdivisions of brand-new homes sit largely empty, with builders slashing prices but still unable to move inventory. City number 2, Casa Grande, Arizona. Casa Grande has witnessed a housing market implosion that rivals Queen Creek's severity. Median prices have crashed from $385,000 at peak to $245,000 currently, a devastating 36% decline that represents the steepest drop in the state. The city's inventory has exploded to over 100 active listings in a city of just 65,000 residents, representing nearly 15 months of supply. Properties sit on the market for an average of 172 days, with 81% of listings eventually reducing their asking price by an average of $35,000. Casa Grande's collapse stems from multiple compounding factors. The city positioned itself as an affordable alternative to Phoenix, marketing aggressively to priced-out buyers during the boom. However, Casa Grande lacks the employment base to support its population growth. Most residents commute 45 to 60 miles to Phoenix or Tucson for work. Water scarcity concerns are particularly acute. The city has faced construction restrictions and ongoing debates about sustainable growth given limited water resources. The Nikola Motor scandal also damaged confidence in Casa Grande's economic future. The company's highly publicized factory project, which was supposed to bring thousands of jobs, has been scaled back dramatically. Small builders have filed for bankruptcy at alarming rates, leaving some developments with unfinished infrastructure and abandoned construction. The city now has over 850 single-family homes listed for rent, driving vacancy rates above 16% and rents down by 24% from peak levels. City number 3, Buckeye, Arizona. Buckeye's median home prices have plummeted from $485,000 in mid-2022 to $325,000 in early 2026, a 33% drop that has devastated this once booming western suburb. Inventory levels have quadrupled since 2022, with over 1,350 active listings. Days on market average 165 days citywide, but exceed 200 days in many outlying developments. Buckeye was ground zero for speculative development during the pandemic. Between 2020 and 2024, the city approved over 45,000 new housing units, transforming desert landscape into massive subdivisions at a breakneck pace. This explosive construction was driven entirely by speculation, with developers betting that Phoenix's westward expansion would continue indefinitely. However, Buckeye's extreme distance from Phoenix employment centers, over 35 miles to downtown, has proven catastrophic as gas prices increased and remote work ended. The commute can exceed 90 minutes during rush hour. Water supply issues are critical, with the city's rapid growth straining infrastructure. Summer temperatures in Buckeye routinely exceed those in central Phoenix by several degrees, making cooling costs even more burdensome. The impact has been felt most acutely in the city's massive master-planned communities, where prices have dropped 35 to 40%. Property owners face not only declining values, but also high HOA fees, often $250 to $500 monthly, for amenities in communities struggling to reach full build-out. Many homeowners who purchased in 2021-2022 face losses exceeding $160,000. City number 4, Surprise, Arizona. Surprise's housing market has crashed from a median of $475,000 at peak to $335,000 currently, a 29% decline. Active inventory has surged to over 1,200 homes, representing approximately 9.8 months of supply. Properties languish on the market for an average of 148 days, with homes priced above $450,000, averaging over 195 days. Surprise marketed itself as a retirement destination, similar to its neighbor Sun City. However, the demographic shifts have proven problematic. Stock market volatility and economic uncertainty have caused many prospective retirees to delay their plans or choose lower-cost destinations. Property taxes and insurance costs, which can total $12,000 to $15,000 annually, have proven shockingly high for retirees on fixed incomes. The city also faces challenges related to its distance from Phoenix, approximately 25 miles northwest. Young families who purchased during the boom are now struggling with long commutes and limited local employment opportunities. The rental market has softened dramatically, with vacancy rates climbing above 12% and rents declining by 17% from peak levels. Entire retirement communities that were selling homes rapidly in 2021 now sit with unsold inventory. Some builders have abandoned projects mid-construction. The retiree-focused businesses that proliferated during the boom are struggling with declining membership and patronage, creating a negative economic spiral. City number 5, Maricopa, Arizona. Maricopa's median home prices have declined from $425,000 at peak to $285,000 currently, a stunning 33% drop. Active inventory stands at over 980 homes in this city of approximately 70,000 residents, representing over 13 months of supply. Days on market average 161 days. The Maricopa market has essentially frozen, with sales volume down over 65% from 2021 levels. Maricopa was marketed as the affordable Phoenix alternative, but the city's extreme isolation has proven to be its downfall. Located approximately 35 miles south of Phoenix, with limited highway access, Maricopa functions purely as a bedroom community. Between 2020 and 2024, Maricopa's housing stock increased by over 55%, with massive developments transforming former farmland into subdivisions. This explosive construction was driven entirely by speculation and low-price appeal rather than economic fundamentals. When the market collapsed, Maricopa was left with thousands of excess homes and virtually no buyer demand. Water concerns are particularly acute. The city relies entirely on groundwater, and sustainable growth questions loom large. Schools are overcrowded, shopping and entertainment options are limited, and the commute to Phoenix can exceed 75 minutes each way. Property owners who purchased in 2021 to 2022 face catastrophic losses. Many owe $140,000 to $170,000 more than their home's current values. The rental market has completely cratered, with vacancy rates exceeding 15%. Foreclosure filings have spiked by over 110% compared to 2023. Entire neighborhoods of brand-new homes sit largely vacant. City number 6, Tucson, Arizona. Tucson's median home prices have fallen from $385,000 at peak to $295,000 currently, a 23% decline that masks extreme geographic variation within the city. Some neighborhoods, particularly in the northwest suburbs and outer Oro Valley, have declined by 30% or more. Active inventory stands at over 5,200 homes, representing approximately 7.8 months of supply. Tucson's housing challenges stem from multiple factors. The city lacks the high-wage employment base of Phoenix, with median household incomes approximately 20% lower than the state's largest metro. The local economy relies heavily on education, healthcare, and tourism, sectors that offer lower average wages than tech or finance. The University of Arizona's enrollment challenges and budget constraints have created uncertainty about the city's economic anchor. Overbuilding in Tucson's northwest corridor and Oro Valley area has created massive oversupply. These areas attracted heavy investor interest during the boom, and investors are now flooding the market with listings. Water scarcity concerns are particularly acute in Tucson, with ongoing debates about sustainable growth and water rights. Summer heat that routinely exceeds 110 degrees Celsius has become increasingly difficult to manage as electricity costs have soared. The neighborhoods most affected are newer developments in Oro Valley, Marana, and the northwest side, where investor concentration was highest and prices have declined 28 to 35%. The rental market has seen vacancy rates climb above 11% and rents decline by 16% from peak levels. Some areas now have zombie properties, homes abandoned by owners who walked away rather than continue payments on deeply underwater mortgages. City number 7, Gilbert, Arizona. Gilbert's median home. Prices have crashed from $625,000 at peak to $445,000 currently, a 29% decline that has devastated the upper middle-class segment. Homes priced above $650,000 have seen declines exceeding 33%. Active inventory has exploded to over 1,450 homes, representing nearly 9.5 months of supply. Days on market average 142 days, with luxury homes averaging over 185 days. Gilbert was heavily targeted by investors during the pandemic boom. Investors accounted for an estimated 31% of all Gilbert home purchases in 2021 and 2022, among the highest rates in Arizona. When the market turned and rental vacancy rates climbed, these investors scrambled to exit, creating massive downward pressure on prices. The city also faces challenges related to affordability limits. Property taxes and insurance can total $15,000 to $20,000 annually on higher-priced homes. The monthly payment on a $650,000 home at 7.5% interest is approximately $60, far beyond what most families can afford. Tech sector layoffs at major employers have reduced high-income buyers. The premium that buyers once paid for Gilbert schools and amenities has largely evaporated. Many high-earning professionals are now trapped, unable to sell without losses that would consume their entire down payment and more. The luxury rental market has collapsed under excess supply, with rental homes sitting vacant for months. Homeowners in newer developments on the city's eastern edge have watched their values decline by $150,000 to $220,000. City number 8, Scottsdale, Arizona. Scottsdale's luxury housing market has experienced a particularly severe correction. While the overall median has declined from $895,000 at peak to $665,000 currently, a 26% drop, the luxury segment above $1.5 million has crashed by 35% to 40%. Active inventory stands at over 2,100 homes, representing approximately 11 months of supply. Luxury homes priced above $2 million average over 225 days on market. Scottsdale's collapse stems primarily from the luxury market freezing completely. When mortgage rates climbed above 7%, high-end buyers disappeared virtually overnight. The monthly payment on a $2 million home at 7.5% is approximately $1,600, a figure that eliminates all but the wealthiest cash buyers. Stock market volatility has reduced liquidity among potential luxury buyers. Corporate relocations that historically supported Scottsdale's market have slowed dramatically. The city also faces unique challenges related to water scarcity. Scottsdale's decision to cut off water to the Rio Verde foothills community in 2023 created national headlines and raised serious questions about water availability. Luxury homeowners face astronomical property tax and insurance bills, often $35,000 to $50,000 annually combined, creating ongoing affordability challenges even for high-income households. The luxury vacation rental market, which exploded during the pandemic, has completely collapsed as Scottsdale implemented stricter regulations and oversupply drove down rental rates. Many investors who purchased luxury homes specifically for short-term rental income are now facing negative cash flow and are desperate to sell. Recovery in Scottsdale's luxury segment appears unlikely before 2030 or beyond. Several critical themes emerge from Arizona's housing collapse that reveal deeper structural forces reshaping the state's real estate landscape. The most striking commonality across all 8 cities is the devastating impact of speculative excess and institutional investor activity. Capital flooded into Arizona real estate during the pandemic boom with the assumption that appreciation would continue indefinitely and remote work would permanently reshape living patterns. When these assumptions proved false, the correction was swift and brutal. The second major theme is the catastrophic mismatch between construction activity and organic demand. Builders continued delivering new homes long after market conditions had clearly shifted, driven by speculative financing and development momentum rather than actual housing need. The result is a massive oversupply that will require years to absorb, particularly in outlying cities like Queen Creek, Buckeye, and Maricopa. The third critical theme is Arizona's unique environmental and infrastructure vulnerabilities. Water scarcity, extreme heat, rising utility costs, and insurance challenges have transformed from abstract concerns into concrete barriers to Arizona's growth. These factors are increasingly influencing buyer decisions and will likely constrain Arizona's long-term growth potential. The fourth theme is the fragility of bedroom communities lacking diversified local employment. Cities like Casa Grande, Maricopa, and Buckeye, which exist purely as bedroom communities for Phoenix, have proven extremely vulnerable to changes in commuting patterns and remote work policies. The pandemic-era assumption that location no longer mattered has been decisively disproven. The Arizona housing collapse is affecting the state's broader economy in multiple ways. Consumer spending has declined sharply as homeowners feel significantly poorer. Property tax revenues are declining as assessed values drop, forcing municipalities to make difficult budget cuts. The construction industry has contracted dramatically, with widespread layoffs and small builder bankruptcies. The psychological impact of widespread negative equity is affecting Arizonans' confidence in home ownership as a wealth-building strategy. Looking at national implications, Arizona serves as both a warning and a potential preview for other high-growth Sunbelt markets. Cities in Florida, Nevada, Texas, and North Carolina that experience similar pandemic booms are showing early signs of corrections that could mirror Arizona's trajectory. The factors driving Arizona's collapse – speculative excess, overbuilding, affordability limits, and environmental challenges – exist in varying degrees across the Sunbelt. The Arizona housing market crash of 2025 and 2026 represents one of the most severe real estate corrections in state history. Price declines ranging from 23% to 36%. Median home values down $100,000 to $280,000 from peak levels. Inventory levels up 300% to 425% in some markets. Tens of thousands of homeowners underwater on their mortgages. Entire communities transformed from booming growth engines into struggling markets with abandoned developments and plummeting tax bases. These aren't just statistics, They represent real financial devastation and profound uncertainty for hundreds of thousands of Arizona families who believed they were making sound investments in their futures. For current homeowners struggling with declining values and negative equity, the crucial insight is that housing must be viewed through a long-term lens. If you can afford your monthly payments and don't need to sell immediately, riding out the downturn is almost always preferable to selling at a catastrophic loss. Home values will eventually stabilize and recover, even if the timeline extends well beyond initial hopes. Focus on maintaining your property, building equity through principal payments, and waiting for market conditions to improve. For prospective buyers, this market presents opportunities not seen in over a decade. Prices in many Arizona cities have returned to 2018 or 2019 levels, and desperate sellers are negotiating on price, closing costs, and repairs. However, approach with clear eyes and realistic expectations. Purchase homes you can afford comfortably at current rates. Focus on established neighborhoods and employment centers with proven resale history, carefully evaluate water availability and environmental risks, and plan to hold for at least 7 to 10 years, minimum. For real estate investors, the lesson is stark and unforgiving. Speculation and leverage are catastrophically dangerous when market fundamentals shift. Those who avoided the speculation frenzy and maintained substantial cash reserves are now positioned to acquire properties at significant discounts. The key is patience, rigorous due diligence, realistic return expectations, and focus on areas with strong economic fundamentals rather than speculative growth stories. Looking ahead, Arizona housing markets should begin stabilizing by late 2026 or 2027, as excess inventory is gradually absorbed and prices reach levels genuinely supported by local incomes and economic conditions. Recovery will be gradual, uneven, and painful, with some cities rebounding faster than others based on employment diversity, water security, and infrastructure quality. Full recovery to peak prices appears unlikely before 2030-2032 for most markets, and some outlying areas may never fully recover. The Arizona housing crash of 2026 will be studied for years as a cautionary tale of speculation, overbuilding, environmental constraints, and market psychology. For those living through it, the experience is financially and emotionally painful, but ultimately survivable. Housing markets are cyclical by nature. The boom years of 2020 or 2022 were abnormal and unsustainable. The crash of 2025-2026 is a harsh correction back to reality, and eventually a more sustainable, stable market will emerge from the wreckage. The question for Arizona is whether this crisis will prompt meaningful policy changes around water management, sustainable growth, and speculative development controls, or whether the state will simply repeat these cycles in the future.